Okay. Good morning, good afternoon, and good evening from wherever you're joining us from around the world. Welcome to the Statutory Compliance webinar series that Grand Scale CFO is bringing to you. We're looking at educating the business owner in a way that empowers them to run their business effectively. So it's a good thing that you are here and you have joined. Whenever it is that you are looking at this, if you're watching us live, great. But if you're going to see this later, we also just want to welcome you. Just a little bit about Grand Scale CFO and what we do. We help leaders and their organizations to grow that organization as well as to improve their cash flow by providing financial strategy, accounting services, tax compliance services, as well as training or coaching on scaling up. And this is our core business. And the reason why we do this is we want to give the entrepreneur financial freedom. We also want to eradicate poverty in Africa, and that is the reason why we are on this mission. Our big, hairy, audacious goal is that by 2042, we want to have influenced the establishment of at least 1,000 African millionaires and at least 50 unicorns, billion-dollar businesses. And we are challenging ourselves to be that company that partners and becomes a financial friend, helps the entrepreneurs and their leadership teams to build grand scale companies. And that is why today we have started this webinar series. Our webinar series now starts with statutory compliance because it is an important part of building your business. Very good way to know how to be compliant to your regulator. So tonight, we've got a speaker. She is one of the CFOs at Grand Scale CFO. She holds a degree in accounting and a postgraduate degree in accounting as well. Has had more than 6 years of experience in the accounting and CFO field, is a former partner of an accounting firm, very well versed in the stuff, in everything statutory compliance based. She is passionate about it. She is also passionate about growing businesses and helping entrepreneurs become the best that they can be. She's a business coach and also a personal coach. Ladies and gentlemen, help me to welcome Miss Gugulethu Moyo. Please take it away, Gugu.
Unmute. Thank you very much, Uno. Appreciate that introduction. And I think without further delay, you did mention that as the beginning and as we commence this webinar series, we begin with the very most important things when it relates to business, when it relates to starting a business. I mean, it's easy for an entrepreneur to think, I mean, that's what business owners do. They think about how to make money, but the consequence of that thought or the aftermath of that thought is the administration that comes with it, which is then therefore why statutory compliance becomes relevant. And it might be termed so, I would say, boldly or big terms, but really it's just post-registering your company, being able to comply with the different regulatory bodies. So what are those regulatory bodies that we're talking about? So maybe before we even get there, why compliance? Why is compliance topical and why is it relevant? I think in my experience and over the past however many years I have been in practice when it comes to dealing with entrepreneurs and business owners is I've identified that there is a big knowledge gap, right? And rightfully so, because we are not trained to be business people. I guess it's survival instincts. When the survival instincts kick in, that you need to make money, and you come up with an idea. This is how I'm going to make money. You do not have handy the laws that comes with registering a company. So therefore, that knowledge gap between accountants, between tax practitioners, and entrepreneurs and business owners is quite huge. And then that results to non-compliance. So over and above that, opportunity-based. So compliance becomes very topical when a business owner has heard of a tender or has heard of a business opportunity that requires them to be either registered to begin with, if not registered, to have a tax clearance or to have a BEE certificate. And then over and above that, the other reasons for non-compliance is just business owners not being able to keep tabs, that is, keep a dashboard, a live dashboard that allows you to track compliance. That is, if you've got poor internal controls in your business, you are unable to monitor and track your compliance with the different regulatory bodies. And then for some businesses, it's just not a priority. So it also feeds into the knowledge gap. It's just not a priority. We are making money. Our business model is working. SARS hasn't knocked on our doors. Nobody has said anything to us. And therefore, it's business as usual until a particular time. And then the other reason to non-compliance would be I've just noticed over time that the statutory bodies themselves are a lot more reactive than proactive. So they would impose things like fines, penalties, but they would not be extreme in terms of either putting it in the business's faces or business owners' faces that you need to comply with CIPC, you need to comply with SARS, you need to comply with the Department of Labor. I know that the Department of Labor has tried at some point when the compensation fund, when it's a new year, they will try as much to encourage employers to register, but it's not in our faces. So that becomes quite a difficult, or let's say a difficult knowledge to grasp for entrepreneurs over and above the daily activities that they are dealing with. Or whatever that they will be challenged with when it comes to operations. So having then had laid this context, why is compliance very important? So as you register your business, depending on the type of business it is, all of these businesses have to go through the different stages of compliance, right? So PTY Ltd being a private company, which is the majority of companies that we work with or deal with. Closed corporations are still in existence, although the new registration of closed corporations has been stopped. And then we've got nonprofit organizations or nonprofit companies. And then we've got public companies, we've got cooperatives, we've got personal liabilities. So these are the different types of companies that one can start depending on what it is that they're trying to achieve with their business. But it doesn't matter the type of your business, you are not exempt when it comes to compliance. And just briefly, an overview of, I would term it a compliance dashboard. You start off here at CIPC, you move over to SARS, you move over to the Department of Labor, you ensure that you're also compliant with the POPI Act, and then depending on the industry that you are operating under, there is additional specific compliances that are required for those different companies. For example, if you're in the food industry, you must get a certificate that shows some health and safety assurance. If you're in construction, you must be registered with I think it's called CIDB. So compliance is quite a complex, but an overview of it, or the one that is very, I would say, general, or that applies to all the different types of businesses, is you must be registered with CIPC. You must have engagement with SARS at some point. If you have employees, you must register with the Department of Labor. You must make a declaration with your employees. And then if you handle personal information, doesn't matter whether it's that of your employees, doesn't matter if it's that of your clients, you must be compliant with the POPI Act, an act that regulates how you protect and how you share information that relates to the specific personal details of individuals. So that is an overview of a general compliance that one needs to take into account when registering a company. So we'll start right straight with the Companies and Intellectual Property Commission, CIPC. So CIPC is the kind of like, it brings your idea or your whatever that you're trying to achieve in a business format and make it a legal person as in separate you as Google to the company, right? So in law terms, they will call it a legal entity. But basically, that's a number one. As soon as you register your company, you should start treating it as that, as a legal person, as a separate entity from yourself. It speaks to getting a business bank account separate from your personal bank account. It speaks to having some form of administration put in place for decision making. You're no longer making decisions for Google. We are making decisions for this legal entity that is regulated, or that is that answers to the commission, right? So in this case, there is the Companies Act. The Companies Act allows businesses, or defines laws in which businesses operate. It's quite complex, not very necessary for business owners to really know the nitty-gritties, but if it is that you are faced with a particular issue that requires consultation, I'd say consult with your accountant or your lawyer when it comes to business administration. And then subsequent to then registering your business, you don't just stop there. So it's common practice for businesses to think, my business is dormant, it's not trading, therefore I don't owe anybody anything, right? Unfortunately, you have created, or fortunately rather, it's unfortunate for people who hate administration, you have created a legal entity, right? Then this person, separate person from yourself, has rules that they must adhere to, right? So whether you are trading or not, you do not need to be reluctant and say, I don't need to tell anybody that I'm trading. Nobody will come after me, right? Unfortunately, if you stay wherever you are without saying anything to SARS, without saying anything, in this case to CIPC, over a period of time, you would be deregistered. And it defeats the whole purpose of registering right at the beginning. So annually, you need to submit a return to CIPC each year on your anniversary date. So if it is that you registered your business today, being the 26th of April 2024, you would need to submit an annual return in the following year in the same date. And then the CIPC website goes as far as having a calculator for you. And the reason why a calculator is very important is for those that would be in business and perhaps their turnover is now above $1 million. There is a need for you to punch in whatever turnover that you would have made and determine what you need to pay to CIPC, right? And then what's quite topical lately is the term beneficiary ownership, the BO. So it has become very important for businesses. So in the past, they just used to be a company share register, and a company share register was administered privately, right? It wasn't public information to know who's owning this business and to what interest do they have in that particular business. However, I think as of April 2023 last year, CIPC has been required, actually South Africa as a country has been required to have beneficiary ownership registrations taking place. A beneficiary ownership is simply just means who owns the company and to what degree do they own the company. And why is this important? It is important so that the government or whoever, say, I think is in the wrong side of the law, it's important for the government to know who has been calling the shots in this business, who has the legal rights to the profits of the business, and therefore make that person directly responsible for whatever it is that they would have done. But it's just for administration purposes for the entire country to know, or yes, for the entire country to know to what degree is this private business owned and who's owning it and how much are they owning in that business. I think to be very specific, the explicit percentage is if anybody owns anything above 5% of any business, they are required to register as a beneficiary owner of that particular business. So that becomes very important. And then the other just regular compliance when it comes to CIPC is regular updating of your emails, regular updating of your addresses, regular updating of your directors, or if you want to change a name, that must be done at CIPC so that it is recorded officially. And if there's any correspondence that gets sent directly to you and you receive it in time, and you don't receive any correspondence that maybe relates to your annual returns because you didn't update your contact details, for example. So it's important across board in all the different statutory bodies to ensure that your contact information is up to date. So then what happens when we are not compliant? So the business owner has registered the business and they became very reluctant or whatever happened, life happened, and they didn't do any submissions to CIPC, or they didn't do the beneficiary ownership that has of late become a requirement, a compliance requirement. So there is administration fines for not declaring who's the shareholder of that company and to what degree you are owning shares in that company. Then for those that would go as far as 2 years not making a declaration with CIPC, CIPC will issue out a notice to those companies and will actually publish that list of companies that are due for deregistration. Kind of like it gives you a bit of time and grace until you file your annual return. But provided that you don't know whatever happened, you were not made aware of this, your company goes into final deregistration. And if you're trying to engage with the bank, if you're trying to engage with the investors, nobody will hear you because you do not have a legal entity. You don't have a registered company. And it's quite expensive to try and get your company restored. Yeah, so that would be everything when it comes to CIPC. Uno, please give me a heads up when we do get questions. I'm happy to take them as I am going. So with that being said, then
no questions at the moment. I'm sure you can go ahead. And if you have any questions, you can put them through the chat box, or if you want to ask them after she's done with her presentation, please feel free.
Okay, thank you. And then we move over to SARS. So South African Revenue Services, right? So I've tried to list the steps when it comes to SARS. I think SARS is one of the bodies that are very harsh, whether in penalties. I think of late there was a an article about, I think how many, is it five business owners who were imprisoned. Apparently, one of the business owners' wife found out that there is a 90,000 a girlfriend allowance to a side piece that they had. So I guess this aggravated wife was like, I will not keep your terrible shenanigans hidden. And then they went and exposed this shady business dealing. So SARS is quite harsh in fining, in just punishing people who are not compliant with them. So this slide is trying to explain how do you go about complying with SARS, right? So we'll start right from the beginning. The moment you register your company, you by default get an income tax reference number, right? So I will explain this in this tab number 2, that speaks to the different tax types, right? But the moment you are done with step 1, as in my previous slide, that speaks directly to CIPC, you immediately get an income tax reference number. And then once you have got that, you are then required to do additional administration with SARS, as in register SARS e-filing profile, or if you don't have the time for that, at least consult an accountant to have or assist you when it comes to the SARS administration. So you are unable to do any dealings with SARS until your company has appointed a public representative, right? So what is meant by a public representative? A public representative is somebody that receives correspondence on behalf of the company from SARS and sends correspondence or any communication to SARS on behalf of the company, right? It goes as far as even the public representative being directly responsible for any delay in submitting returns to SARS, or delay in making payments to SARS, or just not complying with the income tax laws, right? So you are basically saying, and usually it's the director of the company. If it's not the director of the company, somebody who has a direct benefit of the profits of the company, so that you don't, as an employee, find yourself liable for a company that you are just merely working for. And then the other thing to mention when it comes to public representative is that it's easy for business people to outsource accounting services and say SARS return services, right? And then they immediately think that they have delegated the responsibility, therefore they are not compliant. Unfortunately, being a director of the company, I don't know why I'm saying unfortunately, but I guess what I'm trying to say is it doesn't work that way. How it works is your accountant is merely your representative. You delegating or outsourcing accounting services doesn't make your accountant responsible for the returns as well as the money that needs to be paid to SARS, right? So by all means, when you register a company, you become responsible for that company as a whole, and doesn't matter who you appoint to provide a particular service for your company. Any failure to comply with the tax regulations is solely the director's responsibility or the owners of that company's responsibility, right? So I hope I've covered public representative and it makes sense. So the moment you have registered your public, you have appointed a public representative and you have had this registration at SARS, then you are able to have engagements with SARS. You are able to even submit returns with SARS, right? So that's quite a very important step. And then we move over to deciding if you want to register for additional tax types. So what is a tax type? A tax type is basically a reference, right? It's a reference that you use for the different income, not income tax, for the different tax correspondences, right? So income tax is a different tax reference. Then there is pay as you earn, which deals with employees tax, which is a different tax reference. And then there is VAT. VAT is also a different tax type, which deals directly with your selling and buying of goods, right? So it's different tax types and different references. Usually, business owners would think that their income tax type reference is the number that is used for all the different tax types, which is not the case. And then the last administration there, similar to CIPC, is just ensuring that your details are always up to date, right? It speaks to your bank account details, it speaks to your email address, it speaks to your address, your physical address, it speaks to your public representatives details, as in who SARS gets to send information to. That person should be receiving all the information timely, right? Then on the second step, it's returns. So once your administration is set and done, depending on the level of your trade and where you are, these different tax types will be applicable to you. Income tax, pay as you earn, UIF, skills development levy, and then there's VAT, then there's customs. Customs is quite a bit different and not as regular because it speaks to the people who are importing and exporting, quite relevant to the people who have international trade, right? I think what I want to explain more here on is on the pay as you earn and the income tax. That has a separate slide, which I would take you guys right once I'm done with income tax and pay as you earn. So income tax is administered twice a year, actually 3 times a year. You've got provisional tax, depending on when your financial year ends. But if we are using the SARS generic financial year, which begins from the 1st of March and ends on the 28th of February, your first provisional tax will be due on the 31st of August. And your second provisional tax will be due on the 28th of Feb. Then you are given 12 months to submit your final assessment, combining the first provisional tax, the second, and whatever it is that you would have arrived as a final, say, set of, let's call it your final taxable income, right? And then pay as you earn is applicable to companies that have employee, basically UIF, pay as you earn, and skills development levy is applicable to companies that have employees, right? The moment you register, so when you register these tax types, you immediately get a UIF reference number. Then you would decide if you want to do a skills development levy or not. If you select that you want to do a skills development levy, that also you automatically get a reference number for that. I will clarify the SARS UIF and the Department of Labor's UIF, I think on the Department of Labor slide. So what happens with pay as you earn is that SARS is basically saying the easiest way for us to tax people, this is individuals. So individuals like humans, employees, they're different from companies, right? So the easiest way for us to administer that is from their place of employment, right? As in, SARS doesn't want the struggle of going to Google personally and just confirming if I've declared all the information. SARS is saying, okay, well, you are employed. The easiest way for you to be paying us tax is on a monthly basis as you are earning your salary, right? And then your employer is the one that's going to be withholding that tax, basically holding the tax on your behalf and paying to SARS on your behalf. Your behalf, I'm referring to the individuals or the employees. right? So this is done on a monthly basis, and the last day in which companies must file a pay-as-you-earn return and UIF is on the 7th day of the following month. So if payroll was done today, being the 26th of April, your accountant must ensure that they've submitted a return to SARS at least by the 7th of May the following month, right? And then I don't know if there's questions here. I'd like to move to the next pillar here. I think what's quite important to mention that is closely linked to returns is the business records or record keeping, right? So you cannot submit a return in whatever form without keeping records. That is without knowing how much money you made for that particular month, how much money you made in the year, without knowing how many employees you have, how much money did you pay your employees, right? So then this pillar, the blue pillar, is trying to explain the types of record keeping that you should be putting in place in your business to ensure that you are submitting your income tax return on an annual basis or every 6 months. You're submitting your pay as you earn every month, your VAT every second month or every month, depending on how big your revenue is. So it's important then that you have a bookkeeper. If not a bookkeeper, you've got you have an accounting system that is tracking how much money you've received, how much have you paid in whatever in terms of suppliers and buying your stock. You also need to be keeping your invoices and receipts. The reason why it's important, it actually just goes with bookkeeping altogether. Then when you submit an income tax return and SARS has questions around that, you've got proof to submit to SARS and say, these are the records I've been keeping, therefore this is why I've submitted that information, right? And then VAT reports quite relevant to accountants, but basically it's just saying how much VAT input did I pay in terms of when I was buying from suppliers, when I was paying my operational costs, and then how much VAT output did I receive from my clients. Kind of like there must be a calculation put in place to help you then submit that. But on a basic level for business owners, bookkeeping is a requirement, very important. Invoices must be kept. There is a way of keeping invoices lately. You can take a picture of an invoice and save it on your accounting system. There's no need for the whole filing thing that we used to do. As you buy your petrol at petrol station, take a picture of your receipt, send it to Xero if it is that you're using Xero as a system. I guess I've just sold Xero there. But there's no excuse for not keeping records in your business. And then what is very then important when once you've kept your records, then your accountant can translate all of this information into a payroll report or into an annual financial statement. So this then helps when submitting either your income tax, your pay as you earn, and your VAT reports, right? And then usually what stresses business owners the most is when SARS either does auto assessment or does a verification for a particular period that has since passed, or when SARS does audits, when SARS does disputes. Actually, SARS does not do disputes and objections, but actually, when SARS issues an auto assessment and verifications as well as audits, right? So it is then important. So what is an auto assessment? An auto assessment is when SARS, by the way, SARS has your information, everything. SARS has access to everything, both for businesses and for individuals. It knows, it has access to your bank accounts. It has access to whatever funds that the business is subscribed to. SARS knows that information. So there is no way you can not make a declaration or make a false declaration and get away with it. so unfortunate. We all need to be compliant with the receiver of revenue. And they have access to everything. And for individuals, they go as far as knowing how much investments do you have, where do you even have these investments, medical aid contributions, your retirement contributions, all the financial institutions that your business or yourself are subscribed to. SARS has access to that information, and it's easy for them to then make auto assessments, right? And then why is this information relevant? It's relevant that at any point you will find yourself having been auto assessed, or SARS requesting a verification for, say, the 2021 May period, where you submitted maybe fewer employees than you usually would, or a VAT verification where you had a refund, and SARS says, no, we want to just verify and confirm that what you had submitted was accordingly, right, or was correct. So SARS now and then would have audits, would have verifications, and would have auto assessments. And it's important then, if you want to either dispute or object, that you keep your records handy, and you can at any point prove to SARS that actually this is how it looks like. Then, having had taken all of this into account, dealing with SARS on a regular and consistent basis, you are able to maintain compliance with SARS, right? It might not be as easy for business owners to do this by themselves. I do recommend that you get an accountant. I do recommend that you consult with the tax consultant for you to know how to handle certain issues. Remember that delegating or getting an accountant doesn't remove responsibility. It's important for a business owner to educate themselves, to inform themselves around penalties, around return dates. When is something due? When do I need to have it submitted? It's very important to have that in place. It's not your accountant's responsibility. It's your responsibility as the owner of the business. And therefore, at all times, ask the right questions and ensure that whoever that you have delegated the responsibility to, they're doing what they're supposed to be doing. I will then move to the next slide. I'm just going to quickly check if there's any questions. If no questions, I will move on. So on the next slide, we are dealing with non-compliance implications, right? So provided that you have not submitted your income tax on time, you have not submitted your VAT return on time, you attract what is called admin penalties, right? So this is a penalty that SARS imposes for a company that has missed the deadline in submitting a return. So again, back to that point of, if your company is dormant and you don't want to tell anybody, or you think you are safe, right? Companies have incurred penalties. I can quote some of the clients that I've dealt with, close to 30,000 whilst being dormant, and accumulate penalties close to that much because they had not made any communication, any form of declaration whatsoever from the time that they were registered until, I don't know, that particular communication then landed or got their attention. So it doesn't matter your trade, it doesn't matter whether you are compliant. I mean, it doesn't matter whether you're making money or not. It is important that you are notifying SARS that actually you're making no returns, or you're not making any income, or this is how much income you have made. And post consulting with your accountant, you will find out that there is a lot of avenues that you can take advantage of within the income tax regulations, right? To not pay tax or not pay so much tax, depending on your level of turnover and where you are. So people usually get very scared to even deal with SARS. It's not an excuse. You need to know, you need to inform yourself, get that information. Even if you're not trading, or even if you're making that much of a turnover, go and make that declaration to SARS, so that you don't find yourself paying the money that you don't even have, you know. So that speaks to admin penalties. And then there's interest. So interest is accumulated on a balance. So say you're owing SARS, you have made a return, and you've submitted it, or your accountant has submitted it on your behalf. And you have taken time, you've missed a deadline, then you accumulate interest. And that interest, it's either on a monthly basis or on an annual basis. So if then that's the case, SARS goes as far as even getting court orders, right? So I explained previously that SARS has access to everybody's information and all the businesses' information. So what SARS does is, if SARS sees that you're making money, but you're not paying the returns that you've declared, SARS will go as far as getting an order to get that third party to pay on your behalf, because third party, I'm referring to a bank now. So there's instances where people would say, SARS took my money, or SARS has access to my bank account. I no longer have the money that I needed for, say, one example that I had is this client had got a payment from a client to buy material. So they're in the construction industry. And as soon as that payment landed from the client, SARS took that money. So can you see how then not communicating with SARS, not submitting these returns on time, would affect your operations as a business? So it's a quite harsh body, or say institution, but it's really not harsh to those that go and ask questions, those that consult with accountants, those that submit on time, those that even go as far as requesting. SARS is very lenient. If you have admin penalties and you have a valid reason why you've got, or you've accumulated those admin penalties, there is a process that allows you to request for that cancellation of those admin penalties. So SARS has been viewed as this harsh body, but really when you are at the door and you're communicating and back and forth, there is always a way around whatever issues that you're faced with. So without taking any time here, I'll move over to the next slide. Just want to break a bit. Are there any questions? Just check with time as well.
Okay, so we've got one question, and I think we've got some other accumulating questions. Maybe we've got 5 minutes to finish up, and then we get the next 10 minutes to ask the questions, and you can address them.
Okay, then. So I'm looking at the time, and I'm seeing that we are almost out of time. So I will try and rush through the last slides. So the aim of this slide is to change the mindset around VAT for business owners, right? And the reason why I think this is important is because business owners think that they're paying SARS when it comes to VAT, right? And why this must change, I'm just going to take you through this process for you to understand why you don't even have to think that you are paying SARS money, right? So before we even get anywhere, the basics of VAT, right, is that if you want to do a voluntary registration, you need to at least have made 50,000 in the last 12 months. And then the one that is required by law, I think I've termed here as involuntary, but the one that SARS really requires you to then be VAT registered is when you're making 1 million or more in taxable supplies. What it means, what taxable supplies mean is that you, in your trade, you are selling and buying whatever SARS is deeming as a taxable supply, right? So there's a whole thing, there's a whole list of things that are taxable in terms of VAT, and list of things that are not, things that are exempt. I don't want to go into that detail for now, but I think what I want to explain here is that to change the mindset around thinking that you're paying SARS when it comes to VAT, how do you even begin? So you need to, the first thing is you need to get your pricing and costing right. The moment you get your pricing and costing right, that is, you know how much it costs you to make, for example, to make bread, right? And you, perhaps it costs you 10 rands, right? And then your pricing, you want to charge 15 rands for that, right? So you already know that you are going to make a profit of 5 rands. So the question, the reason why we're in business is, does that 5 rand make business sense for you, right? The moment it makes business sense for you, don't try and change it because now you're registered for VAT, right? I will explain why I'm saying this. So, okay, we've ascertained that we're making 5 rands profit. Then from that, this is a whole internal process. Then you become either required by state to register for VAT, or you decide you want to register for VAT. So that should be an additional 15% to your prices, to your price, right? So if it is that we're selling our bread at 15 rand, that should be 15%, should be an additional 15% of the 15 rand, right? So therefore, what does that mean? You did your business and you finished, you were happy with your 5 rands. It just means that I've registered for that. Now I've become an agent for SARS. Agent means middleman, right? You're in the middle between SARS and the client, right? You're in the business of adding value, taxable supplies. Therefore, when you become a VAT registered entity, you are required to add 15% of that into your into the cost of your goods, or actually into the price of your goods, right? So what does that mean? You add then the 15%. When Google comes and buys from your business, they pay you 15 rands plus 15%, right? And then what happens subsequent to that? When you, so that 15%, we call it VAT output. That is the money that you have to pay over to SARS, right? So can we agree with that understanding that it's not your money, right? You did your internal processes and you finished, that you were happy with paying, with costing your goods at what, at 15 rands and making a 5 rand profit. But then because you're registered for VAT, you're required by the state to add a 15% to your prices. Therefore, that 15% that Google paid when she was buying your bread becomes the money that you pay over to SARS. We call that the VAT output, right? Then what SARS says is, by virtue of then being the middleman or being my agent, you have benefits of claiming input VAT, right? So the benefit of claiming input VAT is whatever in my 10 rand, remember we said the cost of our bread was 10 rand at number 1. So whatever that I incurred whilst making my bread, buying the flour, buying the cooking oil, buying whatever the milk, whatever that is part of making that bread. Perhaps bread is not a good example because, but let's just say your product, right? Because there's a whole lot of other input products that go, input goods that go into the bread that are not vegetable. So whatever in your manufacturing of that product that landed you at 10 rands, you can claim the input VAT that you paid when you were buying the milk and the oil and whatever that you were using to get to the 10 rand, right? So basically an input VAT is then what you deduct from that 15% that you should have been paying to SARS. So I hope then with this explanation, there is an understanding that once we get our pricing right, that shouldn't be viewed as we're paying SARS, we're paying money, our money to SARS. No, you are merely just adding a 15% to your normal pricing, and you are clear with your profits, and then you are allowed to claim the input VAT that came with your production costs. So with that, I'd like to stop there, Uno. I don't know if I should continue in light of, I think the two slides here were just explaining, they were explaining Poppy and they was explaining the Department of Labor. Just an overview, I think a quick overview, if you'd let me.
Yeah, sure, go ahead.
So with the last compliance here, we're talking Department of Labor, right? So again, by virtue of having employees, there is an unemployment insurance fund, right? So 1% contribution by the employee themselves, 1% contribution by the employer. You need to be contributing to this fund for such a time where your employee is no longer your employee, is no longer employed, for them to have some source of income, right? And then there is a workmen's compensation fund. Workmen's compensation fund says it's basically an insurance put up in place for an event where your employees can get hurt or get hurt at a place of work, then they get covered through the workmen's compensation fund. So all employers are required to be compliant both with the UIF and the Workmen's Compensation Fund. And then we've got the POPI, Protection of Personal Information Act. It speaks to human rights. We all have a right to privacy. It speaks to the preservation of our information. So if you're dealing with clients and you also perhaps have your employees' information, it is important that you have reasonable measures in place to protect that personal information that you would ordinarily not have the privilege to have access to had you not had you not been in dealings with them, as in you were either they were not buying from you or your employees were not working for you, but basically even stakeholders, any person that comes or that is in contact with you, it is your responsibility to ensure that you have reasonable measures put in place to protect that information and you don't expose it recklessly to anybody or to the public without the consent of the owner of that information. I think I'll stop there. Thank you very much. I hope it has been a fruitful one, and I'm looking forward to questions. And yeah, thank you very much.
Fantastic, Gugu. Thank you very much for enlightening us with this, tax knowledge and compliance knowledge. So there are several questions here, and I'm going to read the ones that have been shared on the chat platform, and you can answer them all kind of at once, or should I go one by one? So the first one from Sydney is, how does one deal with separating business and personal expenses? Is it a bad idea to use your business account for personal and business-related expenses?
So thank you, Sydney, for that question. So it goes back to our slide, the first slide. The moment you register your business, you acknowledge, and you must treat and acknowledge it as a separate person from you. So the lawyers call it a legal entity. It has become a separate person from you, right? And I don't know what rules you follow. Perhaps you follow whatever the state says you must do and must not do, in terms of you must not hit a red robot. Those are the regulations that humans follow. And then when it comes to business, there's Companies Act. Companies Act specifies the rules or stipulates the rules that companies must follow. So the moment you register your business, it says you must not be mixing any personal dealings. And the reason why it's also very important, I think if I put in a text spin on this, a text example explanation here, you are unable to claim any deduction whatsoever if you can't prove that it's business related, right? So at any given point, you must be having legitimate business transactions. So if it is that you are using your personal account to do any business dealings, unfortunately, we don't recognize yourself as a business, and SARS will actually only tax you in your personal capacity. And then if it's a company that has a mix, I mean, if it's a business account that has a mix of personal and business expenditures, there's no way you can claim personal expenditure in the business account. They must be legitimate business expenses that would allow you to also claim a deduction when we are doing a tax calculation for your business. I hope that answers you.
That is crystal clear. Sydney, if you want a follow up on that, we will let you go ahead with it. Happiness is saying, before Happiness, Sizagele is asking, can a company contest a SARS penalty if the deduction could potentially lead to bankruptcy? So if I'm going to get bankrupt after this penalty, can we contest this penalty so that we don't get into trouble?
Absolutely, I'd say yes. It's also very dependent on the merits of the case. How did we get that penalty to begin with? So once we ascertain the reasons why we got that penalty, and SARS is understanding towards why we even ended up with the penalty, then perhaps SARS is open to have that engagement. Actually, so that question is very subjective to the circumstances around the penalty. So I think what's important to mention is that you are always welcome to dispute anything that you're not quite happy with, or to dispute anything that you think affects the going concern of the business. So SARS doors are quite open. Go and plead your case in whatever form, and then it's still upon SARS discretion to decide whether they cancel that, reduce the penalty, whatever. But at least have a conversation with SARS prior to paying that penalty, if you feel that it's going to affect the going concern of your business.
Fantastic. I hope, Sizagele, you've been answered there. Certainly, you can be able to contest the decisions that SARS has made and build your case. And that's why we need accountants and public representatives, as Gugu was saying, to help us with these matters. Another question, also from Sydney. Okay. VAT seems to be a delicate matter, and I think you spent some time on it. VAT seems to be a delicate matter. Is a business allowed to charge output VAT even though they are not registered for VAT?
Nope. Nope, they're not allowed. So I think because it's a webinar series, perhaps on the next series, what we can do is we can take business owners through the nitty-gritties of once you have registered for VAT, what is it that you need to look out for? You can't issue a tax invoice you can't add that if you're not VAT registered. So that's a clear no answer, Sydney. Until you're VAT registered.
Absolutely, quite clear. And I think it might be taken as fraud or theft when one charges as if they are stars when they are not able to pay. Right, Happiness is saying, are there any digital tools or software solutions that can streamline VAT management and compliance?
Perfect. Thank you, Happiness, for that. So that actually answers the compliance dashboard. Please repeat the question. I just want to make sure I'm answering properly. Are there any?
Not a problem. It says, are there any digital tools or software solutions that can streamline VAT management compliance?
Okay. I guess maybe it speaks over to both that, I mean, not both, all of the compliances, not specific to that. So there is digital tools. I think before we get to the digital tools, it's having an Excel spreadsheet or even a Word document that is specifying calendar, kind of like the dates, your due dates, when is something due, and then pinning that into your calendar for you to be reminded. But there is digital tools. There's different, I think for accountants, there's different practice managers that allows them to get like alerts for when a particular return is due, or when a vet period is due, or when a CIPC return is due. Then the one that's I think is very much available to the public, quite selling them as well now, would be InfoDocs. So you can check out InfoDocs. It allows you to have a nice dashboard around your CIPC returns, around your annual financial statements. So you can also have a look at that one. I think also just subscribing to an accounting system, or let's not call it an accounting system, because I think the moment we call it an accounting system, business owners think, it's quite complicated. I can't, let's just call it I don't know. It's your typical Xero, your typical QuickBooks, Sage. Of course, they're predominantly used by accountants, but they also allow you to pin important dates and track those as you are going about your daily business operations.
Great. Thank you very much, Gugu. I guess we can do the last one from Happiness. And it is saying, are there any tax deductions or credits available to self-employed individuals that can help reduce their tax burden?
Okay, interesting question. They are. It depends what type of self-employment are we referring to. I think we'll have to be explicit in terms of, are you a sole proprietor? Are you a subcontractor? Like what format do you take when it comes to SaaS? I'm laughing because when I'm answering this, it's easy for somebody to get despondent and think it's too much. Where do I even begin? But I guess the moment you just understand the vehicle that your business is operating under, then it's easy for you to start searching and looking, whether on the internet or asking your accountant. So for self-employed individuals, if it's a sole proprietor, you need to have it be a sole. SaaS allows and recognizes sole proprietors, and you are actually treated as a normal business, as long as you have declared that you are dealing under yourself, then you are able to claim deductions, legitimate all business deductions, and you prove that they are separate from you as individual. Quite actually, as you submit your return as Happiness, you will have yourself as Happiness declarations, and then you will have the sole proprietor as a business as well, and then you will make a declaration of your income, you will make a declaration of all the business expenses that you incurred. So and then if you're a subcontractor, that one is quite fixed. Whatever that you are getting as an individual, that you're invoicing from your different clients, you are taxed at 25%, and your employer is supposed to hold that tax, withhold it, and pay to SARS on your behalf. I hope that's clear.
Excellent. Thank you. And Happiness says, thank you for answering me on that one. I think we've got a whole, buffet of information from this compliance webinar. And I'm happy that it's one of the first that we've had. But there are many, many nuggets that have come out of this webinar. First, just knowing that SARS has all your information. So you need to kind of make sure you are, compliant, and you can't lie to them. So, you might as well just make sure. And all the different kinds of taxes that are there as well that you need to be sure of. And also just knowing that you can negotiate with SARS. Nah? You can negotiate.
Yeah. Can have a
Depend-
conversation with us.
Absolutely, absolutely. And so you need to befriend SARS, and certainly Grand Scale CFO can help you befriend SARS, so that
Yeah.
you do not have the burden of feeling like, I need to be running away. You can't face it at some point. I think the other point you mentioned was this auto assessment or something like that, right? That they can just start today. But wanna know, show us where you got this and where you got that, so that we know whether you pay. Or they can go directly to your bank. That was another one. Sizagele says it's super creepy, and go and take your money directly if you're not doing the right thing. So if you're a business owner out there, please take note. These are things that are very important and that you need to take note of so that you are compliant. Let me take this opportunity to thank everybody who has attended this webinar. Thank you very much for coming through. It's very important that you made it and you invested your time in this webinar. Let's meet on the next one. Please follow us on Grand Scale CFO on LinkedIn, and we will update you on the many webinars that are coming through and all the empowering information that will help you to grow your business and improve the cash flow in your business. Thank you very much. Good morning, good afternoon, and good night.
Thank you. Have a good evening. Bye.